Welcome to Crypto Literacy. Today we're taking a look at Australian tax basics for cryptocurrencies. In a nutshell, if you live in Australia and you've ever bought cryptocurrency like Bitcoin, then you'll likely fall into one of these three primary categories. First, we have the traders. This group likes to buy and sell regularly. It might be a couple of times a day, or less than once a week. They record the sale of cryptocurrency as income, and purchases become expenses. This is what we call a revenue account, and this is treated the same way as any other business that sells goods. Crypto holdings become trading stock, just like groceries on shelves waiting to be sold in a supermarket. Traders work out their profit by adding up all their sales for the financial year and then taking away all their purchases. Any other expenses like mining fees, exchange fees, even running costs for their home office can be deducted from the income to determine their net profit for the year. This amount is added to all other income in the trader's tax return, and they pay tax on that whole amount at their personal marginal tax rate. Next, we have the investors. This is the group that buys cryptocurrency and holds it for long-term gains, and in some cases, generating returns similar to dividends on the share market. The purchase value of the cryptocurrency is called the cost base, and we add any other costs like mining fees and exchange fees to this cost base. Each purchase is recorded separately. We call this a capital account. When we sell the cryptocurrency, we add any costs associated with the sale to the cost base as well. Then we work out the difference between the new cost base and the value of what was sold to determine the capital gain. If the investor held the cryptocurrency for more than 12 months, then they get to claim the 50% discount and cut their capital gain in half. Otherwise, we count the whole capital gain. This amount is then added to all other income in the investor's tax return, and they pay tax on that overall amount at their personal marginal tax rate. We'll call the third group personal users. This group is different from the first two in that they don't trade to make a profit like traders, or hold long term in the hopes that the value of their cryptocurrency goes up to make a capital gain like investors. Instead, the people in this category bought less than $10,000 worth of cryptocurrency, like Bitcoin, with the intention of using it to pay for personal goods and services, like groceries and their electricity bills. They still get the benefit of any increase in value of their cryptocurrency, but because the reason they got involved was not primarily for personal gain, but rather to simply use as a currency like US dollars or the euro, this group doesn't have to pay tax as long as they bought less than $10,000 worth of cryptocurrency. Of course, not everyone fits into these three categories. Some people mine cryptocurrencies, others accept it as payment for goods and services, and some receive their wages and salaries in cryptocurrencies. There are other ways to transact in cryptocurrencies too, but we might save that for another day. So, how do we work out which category you fit into? Well, we need to consider 4 questions. What's the nature of the activity? That is, why did you buy? For profit? To buy goods and services? Was it something else? How regularly are you buying and selling? Is it frequent? Is it a once-off? How do you approach your crypto activities? Do you record everything meticulously? Do you research each transaction? Or do you just buy on a whim? And how much money are you putting into your crypto activities? Is it a few $100s or hundreds of thousands? The answers you give to these questions will decide which category you fall into. Remember, this video is just helping you understand the tip of the iceberg and shouldn't be relied on as advice for you. These are the basics of tax on cryptocurrencies in Australia, in a nutshell.